Every quantitative trader experiences this. A system performs beautifully for months, and then, without warning, it enters a catastrophic drawdown. The code did not change. The logic did not change. What changed was the market regime. Beneath every price chart, markets shift through four distinct regimes: low volatility, mean reversion, high volatility expansion, liquidity crisis, and structured trend. Each state carries its own logic, reshaping volatility and liquidity in ways that challenge even the most robust trading systems. Low volatility, mean reversion dominates in quiet stretches. Spreads stay tight, realized variance drops, and prices hover near a short-term average. Here, mean reversion strategies find opportunity as order books remain deep and stable. But when volatility erupts, sparked by macro shocks or sudden news, the market enters high volatility expansion. Spreads widen, order flow surges, and price swings become violent. Trend-following models may suddenly excel, while mean reversion systems risk sharp losses. The liquidity crisis regime is the most dangerous. Order book depth vanishes, realized variance spikes, and cross-asset correlations soar. In March 2020, as COVID-19 panic swept through markets, liquidity evaporated. Even the most liquid assets saw gapped quotes and wild slippage. In these moments, static technical indicators fail, and only systems attuned to regime shifts can manage risk. Structured trend regimes appear when markets move persistently in one direction, often driven by macro cycles or sector momentum. Volatility may ease, but the rewards favor disciplined trend models over those expecting a return to the mean. Empirical studies confirm these regimes are real. Statistical markers shift as markets transition, and the volatility paradox, calm periods preceding turmoil, recurs across decades of U.S. equity data. Detection lag quietly undermines retail trading. When the market shifts, say from calm to sudden volatility, classic tools like the 14-day RSI, 9-period MACD, and simple moving averages do not keep up. Their formulas, built for stability, wait for several new bars before signaling change. This delay is not trivial. Studies of U.S. equities, futures, and FX from 1995 to 2024 show the median lag between an actual regime switch, marked by hidden Markov models on order flow and realized variance, and the first retail indicator signal is 30 to 90 minutes. In high volatility events, moving average crossovers can lag by up to 150 minutes. The impact is concrete. During a volatility spike, a 1-hour lag can turn a manageable exit into a steep loss. Slippage makes things worse. By the time retail signals react, spreads have widened, liquidity has vanished, and institutional desks have already moved. Quantitative CDFS, built from nearly 3 decades of tick data, reveal over 70% of retail signals arrive after the real regime change is already reflected in order flow and realized variance. This is not just a technical gap, it is a structural disadvantage. While retail traders wait for lagging signals, institutional systems process high-frequency order book data and use machine learning models to classify regime in real time, adjusting positions within seconds. In today's markets, speed is not just an edge, it is survival. A quant researcher lays out the technical arsenal that powers regime-aware trading. At the core is order book imbalance, OBI, calculated as the net volume at the top 5 bid, and ask levels, normalized by total depth. The formula is the sum of bid sizes minus the sum of ask sizes, divided by the total of those sizes. It captures microstructure shifts invisible to retail charts. Realized variance, measured over rolling 5-minute windows of 1-second returns, flags volatility spikes before price-based tools react. Cross-asset correlation matrices, updated every minute on a basket of 10 major instruments, reveal when market stress drives assets to move together. And this is often a precursor to liquidity crises. Hidden Markov models trained on these features use a transition matrix with diagonal persistence values near 80%, enabling real-time regime classification with latency under 50 milliseconds. For deeper temporal patterns, LSTM networks with layers of 64 units process sequences of high-frequency features, delivering regime probabilities that adapt as conditions evolve. These models, tuned with learning rates of 1 × 10⁻³ and drop out at 20%, form the backbone of adaptive execution. The result is a pipeline that senses, classifies, and responds to regime shifts as they unfold, replacing guesswork with engineered precision. When volatility detonated during February 2018, Volmageddon execution engineer teams faced a real-time stress test. As static retail bots clung to outdated MACD and RSI signals, the regime-aware pipeline at Volterra Edge recalibrated within milliseconds. The system's classifier, drawing on live order book imbalance and realized variance, flagged a high volatility expansion in under 50 milliseconds, fast enough to preempt the liquidity cascade. Automated logic slashed alpha weights, shortened holding periods, and triggered capital allocation caps before spreads could widen further. Internal logs confirmed the payoff. While static strategies recorded a 23% drawdown that day, the regime-aware pipeline capped losses at 14%. This reduction was not theoretical. It was engineered in real time, driven by adaptive infrastructure and machine learning at the core of institutional risk control. No system is immune to error. Even the most advanced regime classifiers, whether hidden Markov models or LSTM-based neural nets, face the reality of false signals and operational drift. In practice, a high-performance regime detector will still record an 8% false positive rate and a 12% false negative rate. These errors translate into missed exits or premature trades, each with a tangible cost. Latency is another constraint. The entire pipeline, from tick ingestion to classification, must respond in under 50 milliseconds to remain relevant. Weekly offline retraining, paired with an online exponential moving average update at alpha approximately 0.01, helps adapt to structural changes without overfitting to noise. To manage risk, teams maintain a formal checklist, monitor false positive and false negative metrics, enforce latency budgets, and schedule retraining cycles. Responsible deployment demands rigorous model governance, regular stress tests, and strict operational thresholds. Because in non-stationary markets, robust engineering is as vital as the model itself. Static tools like RSI, MACD, and moving averages fail against non-stationary markets. Only regime-aware systems, driven by live order flow, advanced neural networks, and adaptive execution, stand a chance. In trading, survival favors the dynamically robust.